Thanks, Joanna. Good evening, everyone. First of all, I'd like to thank FSMOne as well as Bursa Malaysia for inviting me to speak to all of you here on understanding leverage and inverse ETFs in Malaysia. I hope all of you are staying safe, keeping safe, and is healthy. Okay. Now, today, the method or mode of the presentation will be a mixture of presentation as well as videos. So later on, you have to pay attention because other than listening to what I explained as per what Joanna mentioned just now, there will be quizzes later on in between the slides that if you answer them correctly will entitle you to a certificate that allows you to trade leverage and inverse ETFs. Okay, so I will cue you later. Yeah, I'll give you a cue as to when you should be paying attention. Okay, now of course, disclaimer, this particular presentation is presented by us, myself, Li Chu from Affin Hwang Asset Management, but representing Bursa Malaysia. Okay, so at the end of this session, you should be able to go home. I mean, all of you are at home already, right? I hope nobody is out and about. So I guess what you will take home with you tonight after this webinar is that you will understand what leverage and inverse ETFs are, or in short, we always call it L&I. Okay, so whenever I the slip and said L&I, it simply means leverage and inverse ETFs. So you'll understand what they are. What are the advantages and disadvantages of L&I ETFs? What are the things to look out for and ways that you can use these products and how you can qualify yourselves to trade leverage and inverse ETFs? So let's begin. I'm sure all of you here roughly would know what ETFs are. ETFs generally, they are index trackers. Of course, they are active ETFs, which we will not talk about today. But on a basic concept, ETFs are just funds that are tracking indices that is listed on a stock exchange, where an investor can then trade the ETFs, invest into them via the stock exchange or brokerage account. So what are leverage and inverse ETFs? So at this juncture in Malaysia, there is only 2 times leverage ETF. Okay, so 2 times leverage ETF aims to give you returns twice, okay, the underlying performance return. Okay, which means that if an index is up 1% for the day, the leverage ETF aims to give you 2 times the return, which is 2%. On the other hand, an inverse ETF aims to give you an inverse performance of the index, which means that if an index were to go down by 1%, the inverse ETF will be up 1%. So do take note that the inverse ETF doesn't come with any leverage ratio. Yeah, so it's just 1 time inverse, but on the leverage side, it's 2 times. And the key word here is to give you daily performance, all right, or rather to give you 2 times the daily performance. Why? Later on, I'll explain what do we mean by the daily performance of the index. So L&I ETFs actually have some similarities to warrants. So like a warrant, L&I ETFs actually tracks the index futures price. So if some of you here, who have traded or invested into structured warrants, you will know that the structured warrants typically will track an index futures. Same goes to L&I ETFs. It tracks index futures prices. Now, the other thing that L&I ETFs have similarities to warrants would be the fact that ETF issuers like ourselves appoint market makers to provide liquidity in the market. So who are market makers? Market makers are essentially the big institutional financial institution or brokers or investment banks who are out there to simultaneously provide the bid and ask price for investors to buy and sell. However, unlike warrants, L&I ETFs do not have an expiry date. So if you have traded structured warrants before, you would know that structured warrants usually comes, or rather it has to come with an expiry date. So when it comes to the expiry date of the structured warrants, what happens is that the warrant will expire. It could be worthless, meaning you lose your entire capital, or it could expire in the money where it will be cash settled and you will receive your returns. Now, other than the fact that L&I ETFs do not have expiry date, which means that you can hold it for as long as you like, it also have typically a lower gearing or leverage ratio. So what does it mean? Structured warrants can actually carry 5 times, 7 times, or even 10 times leverage ratio. But in the case of L&I ETFs, it is only capped to 2 times. Okay. Now, so how does L&I achieve its daily performance? Okay, so this is essentially the investment strategy of the fund of leverage and inverse ETFs, and I will explain to you what does the fund invest in and how do we, as the fund manager, actually gives you that leverage and inverse effect on the ETF. So the instrument that we use here primarily is actually futures contract. So for the 2 times leverage ETF, the fund manager will invest into the futures contract of the underlying index, and we will long the index futures. So for example, if I have an NAV, okay, I'm sure all of you here are familiar with NAV. NAV is net asset value, or AUM of the fund is at 100. Then the fund manager will proceed to long this index futures worth 200, which is 2 times the underlying index, right? And what happens is that if you all know how futures contract works, you do not need to invest or put in 200 ringgit into this investment, because futures are leverage products. So you will only need to fork out some, mostly about 10% as margin for the futures contract. So in this case, most likely the fund will only commit up to 30% of the NAV. So which means that out of the 100 in NAV, we will only use up 30 ringgit to pay to the broker as margin for the futures contract worth 200 ringgit. And the remaining balance of that 70 ringgit will then be used to be placed into short-term bonds or money market instruments, or be left in cash. Okay, so that is for 2 times leverage ETF. Now, what about the inverse ETF? So for the inverse ETF, we will invest in futures as well, but instead of going in a long position for the futures, we will short or sell the index futures. So when we short the index futures, if my NAV is at 100 for this particular ETF, we can only short up to 100 ringgit. All right, meaning you can only short up to the NAV of the fund. And only a maximum of 15% can be committed as margin for this futures contract. And again, there will be cash balances, and these cash balances will then be used to place into short-term bonds, money market, or cash. Okay, I hope I'm not confusing you guys at this juncture. So what I'm going to do now is to play 3 videos by Bursa Malaysia, and pay attention, because right after these 3 videos, there will be polls which I will launch for you to answer the questions. Okay, now let's watch the video together.
Did you know that the first exchange-traded fund, or ETF, was launched in 1993? ETFs began as basic tools that provided exposure to broad indices. Since then, they have become one of the most popular investment vehicles for the investing public. Over the years, more sophisticated ETFs arrive on the scene. One of such are leveraged and inverse ETFs. What is the difference amongst conventional ETFs, leveraged ETFs, and inverse ETFs? Conventional ETFs seek to match the underlying index return. Leveraged ETFs, on the other hand, seek to amplify the return of an index on a daily basis. In contrast, inverse ETFs seek to deliver the opposite performance of the index on a daily basis. Let us look at 3 reasons to trade in leveraged and inverse ETFs. Let's assume you have a view on the KLCI index and decide to use the FBM KLCI ETF for your market exposure. Obtaining 1,000 shares will cost you around 1,780 ringgit. And the possibility of putting that full 1,780 ringgit at risk. On the other hand, an FBM KLCI 2 times leveraged ETF would give you the same FBM KLCI index exposure, but up to 200% daily leverage that would allow you to put up just half the amount of money or less to get similar exposure. So there's less capital at risk. Say you like the technology sector but want to avoid the risk of a single stock collapse. You could choose the basket approach of owning a technology sector ETF to spread the risk. Then, if you want to amplify your return on the bullish side, go with the technology 2 times leveraged ETF. If the collective performance of technology stocks tied to the index rises 1% on any given day, the leveraged ETF will go up 2%. What happens if the market takes a bearish turn? To capitalize on a falling market, you can buy an inverse ETF that tracks the opposite performance of the market, thereby allowing you to take profit when the market falls. In other words, if the market declines by 1% on any given day, the inverse ETF will go up 1%. There is no doubt that leveraged and inverse ETFs give traders many viable alternatives for multiplying gains and benefiting when markets decline. If you are wondering, are these funds right for you? Stay tuned for our next video to find out. This video is for educational purposes only and not intended as investment advice. You've probably heard a lot recently about exchange-traded funds, or ETFs, which resemble unit trusts in structure, but can be traded throughout the day like shares. With the increasing popularity of ETFs, active investors are looking towards leveraged and inverse ETFs to help increase their exposure and stay agile in rapidly changing markets. Leveraged ETFs typically use financial derivatives to magnify the returns of an underlying index on a daily basis. Take, for example, a leveraged ETF with a 2-to-1 ratio. This would mean that every 1 ringgit invested creates a 2 ringgit position on the underlying index. Therefore, on a given day, if the index returns 1%, the leveraged ETF would return approximately 2%. Of course, if the index loses 1% on a given day, then the leveraged ETF will lose approximately 2%. Leveraged ETFs are very useful for investors to quickly gain position with an underlying index. Inverse ETFs use financial derivatives to profit from a decline in the value of an underlying index. In other words, they allow investors to take a position against the market by giving them an opportunity to match the opposite movement of an underlying index each day. If the underlying index falls by 1%, then the inverse ETF would rise in value by 1%. On the other hand, if the index rises by 1%, then the inverse ETF would fall by 1%. It is for this reason that inverse ETFs are advantageous in a bear market. Investors who have exposure to an underlying index or asset could use an inverse ETF to protect their investments, instead of having to sell down. Leveraged and inverse ETFs can offer up to double the returns. However, the higher the potential returns, the greater the potential downsides. Ultimately, while leveraged and inverse ETFs offer new ways for investors to position themselves in the market, investors should learn more about them before jumping in. Stay tuned for our next video. This video is for educational purposes only and not intended as investment advice. Leveraged and inverse exchange-traded funds are short-term trading tools. They are not long-term investment instruments. If you are considering leveraged and inverse ETFs as part of your overall portfolio strategy, please bear in mind the following factors. Are you a conservative investor with a buy and hold approach to investing and cannot tolerate substantial losses in short periods of time? Or are you an active trader more willing to take on higher levels of risk? If you understand the risks associated with the use of leverage and are willing to take on these additional risks, leveraged and inverse ETFs can offer a multiple of the underlying index returns or losses on a daily basis. How actively do you monitor your investments? Given that leveraged and inverse ETFs are more suitable for short-term trading, you must have the time to actively monitor and act on the ETF's performance. These ETFs are not intended for investors who are unable to respond to changing market conditions on a short-term basis. Do you understand how compounding works? Understanding how compounding works is perhaps the key component in any leveraged and inverse ETF. Holding a leveraged and inverse ETF for more than a few days might lead to significant deviation in its performance from the underlying index due to the effects of compounding. As a result, leveraged and inverse ETFs are not meant for conservative investing and best used as short-term tactical trading tools. Investors are advised to refer to the qualification criteria available in the rules of Bursa Malaysia Securities. Please seek the advice of a licensed investment professional before making an investment.
Okay, I hope all of you enjoyed watching that 3 short videos produced by Bursa Malaysia. I see that there are more new participants coming that came in halfway through the video. So what I'm going to do is perhaps just run through a little bit at the beginning section so that you could proceed to answer the poll questions. So for those of you who just joined us, essentially what happens throughout this entire webinar would be, there would be some videos and you know, an explanation and presentation given by myself. And subsequently, there are a couple of questions that we will launch in the poll. Upon which, if you get all the answers correctly, will entitle you to a certificate issued by Bursa Malaysia that qualifies you to trade leverage and inverse ETFs. So very, very quickly, just a recap of how or what leverage and inverse ETFs are. Basically, the leverage ETF gives you 2 times the daily, aims to give you 2 times the daily exposure or returns of an underlying index on a daily basis. And the inverse ETF aims to give you an inverse performance of the underlying index on a daily basis. Okay, I hope you get the keywords. Yeah. All right. Now, so what I'm gonna do now is I'm gonna pull up a poll for all of you to answer. Okay, there are 3 questions. I'll give you a couple of minutes and wait for everybody to fill this up and submit your answers. Okay, so there are 3 questions being asked here. The first question, what is a leverage ETF? Okay, if you can't see the questions or the answers in full, you can actually enlarge the poll. Okay, you can actually enlarge the poll and maximize the screen. So what is a leverage ETF? A leverage ETF seeks to deliver 2 times return of the underlying index on a daily basis. B, an inverse ETF seeks to deliver 2 times return of the underlying index on a weekly basis. And C, a leverage ETF seeks to deliver 2 times return of the underlying index only when market is slow. Number 2, question number 2, there are 3 questions in total, yeah? So number 2, what is an inverse ETF? Okay, answer A, an inverse ETF seeks to deliver 2 times the opposite of underlying index return on a daily basis. Or B, an inverse ETF seeks to deliver the opposite of underlying index return on a daily basis. Or C, an inverse ETF seeks to deliver the opposite of the return of the underlying index in a bearish market. Question number 3, who should invest in L&I ETFs? 1, angel investors. 2, venture capitalists. 3, active investors looking to profit from short-term market movements. 4, investors who want to protect the value of their stock portfolios without selling during a market downturn. Okay, so there are 3 questions in total here. So far, only about 40 of you out of 116 who have participated. Okay, we'll give you a couple of minutes to fill this up. So I hope all of you got the keyword that I mentioned just now in my right before the poll. Okay, for those of you who just came in, if there are any, this poll questions are essentially, basically is a quiz that is set by Bursa Malaysia, and upon answering them correctly, you'll be entitled to a certificate issued by Bursa Malaysia that entitles you to invest into leverage and inverse ETFs. Okay, so there are 3 questions in this poll, and you'll need to stay till the end to watch, I think, 3 more videos at the end of this session, and then I will pull up another poll for you to answer. So I think there are 6 or 8 questions altogether, and you have to answer all of them correctly in order to obtain the certificate from Bursa Malaysia. This is like exam, need to read carefully. Okay, there are about 19 of you who have not answered the poll. Okay, I think we'll wait for another 1-2 minutes, and then I'll end the poll. Okay, so there are 3 questions here that you need to answer. What is a leverage ETF? What is an inverse ETF? And who should invest in L&I ETFs? L&I ETFs are leverage and inverse ETFs. Okay, I think for those of you who have completed this question or answers these 3 questions, maybe you can put in the chat, right? How many of you here have actually attended an L&I webinar? How many of you, any one of you here have attended L&I webinar? Can you please type in the chat box, say me or yes? Never. This is your chance. Very good. Some say yes. Wow. Okay. Okay. Mostly say no lah, which I guess which is the reason why all of us are here, right? So for those of you just curious, those of you who said yes, whose webinar did you attend? Was it mine? Was it my webinar? Or did you attended Kenanga's webinar? Because at the moment, only Kenanga and Afin Huang has leverage and inverse ETFs in Malaysia. Okay, cool, Kenanga. Both yours and Kenanga, very good. So by then, I think some of you here who have attended, webinars like this before, I think you will agree that this is something that you can't digest from just one session, right? Most likely you'll need a little bit more time to try and digest and understand how this product actually works, right? Okay, so I think the number of participants have stopped. So I'm guessing that the rest of you who didn't answer may not be interested. But don't worry, because this is not the only way that you can actually obtain the certificate. In case if you miss this, you can actually go to Bursa Academy's page later on to fill up the questions. But of course, if you do it here and now, then it'll be faster. It's like a fast track for you to get the cert. All right. Okay. Now maybe what I'll do is I think I should be able to move on with leaving the poll on. Yeah. So for those of you who have submitted, I think I hope the poll is not blocking your view. Can I just confirm if, let's say, for those of you who have submitted the poll, is the poll blocking your view? If not, then I'll just leave the poll running. Okay, no, right? It's not blocking. All right, good. All right, then let's continue for the benefit of everyone else and time. Now, L&I ETFs are actually rebalanced daily to meet its objective. Okay, now, L&I ETFs are actually not new instruments in the world, right? So over in the US, there are tons of leverage and inverse ETFs available in the US market. And some are daily rebalanced, some are monthly rebalanced. So how this daily and monthly rebalancing, takes place and what is the impact, etc., I will explain it here. So those leverage and inverse ETF that are listed in Malaysia, as well as most of the Asian countries like Hong Kong, Taiwan, Korea, they are generally daily rebalance. Okay, monthly rebalance is sort of newer as compared to the daily rebalance ones. Okay, so let me first explain about daily compounding interest before I move on to daily rebalancing, because there are some sort of similarity in terms of concept. All right, so let me ask you this question. If you have a savings account and if the bank promises to pay you 3% interest per annum on a daily rest, if you were to measure the actual return of your of the particular savings account over this 1 year period, you will actually notice that the interest rate of your savings account over a period of, let's say, 1 year, the interest rate that you get is not just 3% per annum. It's actually more than 3% per annum. Why? Because returns are given to you daily, and therefore your returns are compounded. Okay, so this concept is important for us to understand the following pages or method of this daily rebalancing. So let's take a look at the 2 times leverage ETF. So how does daily rebalancing works? So let's say, okay, first of all, you need to understand what is NAV. NAV is net asset value, or the fund size or funds AUM for the day. All right, so that's the total funds size that we have. So assuming on day 1, let's say today is the day I start my fund, and I've accumulated 100 ringgit into this fund. So as the fund manager, I need to give you 2 times return. So therefore, I need to be exposed to 2 times of the underlying futures contract. So if I have 100 ringgit times 2, I need to obtain 200 ringgit worth of exposure. Now, assuming if the index make a gain of 10% for the day, your returns for that day would be 200 multiplied by 10%, right? This is simple math, right? So this 20 ringgit, all right, is something that you have actually realized, because this is what we will add back to the NAV of the fund. So with the 20 ringgit gain, and you started the fund total NAV at 100, which means that day number 2, our NAV is no longer 100. Our NAV has grown to 120. So what it means by daily rebalancing? Daily rebalancing means that the fund manager will look at this new NAV, which is 120, and manage the exposure. Because I need to give you 2 times the daily return. Therefore, the next day, I need to increase my exposure to the futures contract by taking the NAV of the fund 120 times 2. So which means that I need to now have 240 ringgit worth of exposure in the futures contract. So bear in mind, yesterday the fund manager only invested 200, which means that today I need to rebalance my exposure and add another 40 ringgit into the invest for another 40 ringgit into this futures contract. Now, assuming if the index make a loss of 10%, that means that for that day, the fund will make a loss of 24 ringgit. And the next day, day number 3, 120 ringgit NAV is my starting NAV, and I need to net off the losses I make for the day, which is 24, which means that the next day, I will start the fund with 96 ringgit NAV. And this 96 ringgit NAV will then be double up again, okay? And which means today I need to be exposed to get an exposure of 192 ringgit, which means that yesterday I had 240, right? So I need to reduce my exposure, sell some contracts to make sure I become to own 192. Why is that so? Why is it important? Because if you take 240 divide by 96, I will be overexposed more than 2 times, and that is not allowed by the Securities Commission. So which is why we manage this exposure every day to make sure that the exposure that we get is always 2 times every day. Okay, so as you can see, these returns are actually compounded over time because essentially is exactly the same like a savings account, the savings account methodology or concept that I mentioned in the previous slide, which means also that today, if on a daily basis, the index is going up, up, up consecutively, okay, if you measure over 3 days, the returns is not just 2 times, it is more than 2 times the underlying index return. So when indices are volatile, it goes yo-yo, up, down, up, down, up, down. What it means is that if you measure the performance of the index over a period longer than a day, you may not get the exact 2 times return. All right, so that is a very important note to understand. Okay, now for the inverse ETF, how is it being managed? It's similar, but the only difference is that number 1, there's no leverage. Number 2, we short the futures instead of going long on the futures. So if my NAV for the day is at 100 ringgit, the fund manager will then proceed to short 100 ringgit worth of the underlying futures contract. So if assuming for that day, the index make a loss of 10%, then the the inverse ETF will make a gain instead because it gives you the opposite inverse return of the index, right? So if it make a loss of 10%, it means that you make a gain of 10%. Okay, so day 2, what happens is the same concept. We get the beginning of the day's NAV at the profit that you make. So you start off the next day with 110 as your fund's NAV. And again, the fund manager will have to rebalance this exposure and now short 110 worth of futures contract. So I will need to add $10 exposure from yesterday. Now, assuming if the index make a gain for that day, that would mean that it has moved in the opposite direction and not in your favor, and you will make a loss of 10% instead. Okay, now and then, oops, what happened? Okay, can you guys see my screen? Okay, good. Now, So for day number 3, because we make a loss of 11 ringgit, so 110 minus 11, you start off the day with 99 ringgit. And again, the fund manager repeats this on a daily basis to rebalance the exposure. Okay, so how then, or what then would impact the return or tracking error or tracking difference of leverage and inverse ETFs? There are two main things that will drive the tracking. The first thing is exposure level. You know, just now I give you a very ideal scenario, right? Where if you have 100 ringgit, you can buy up to 200 ringgit worth of the futures contract. But in an ideal world, it may not be so, you know, rounded up in that sense, right? So I may not be able to obtain 2 times the exact return. Sometimes maybe the fund manager can only achieve 1.8 times or even 1.5 times, 1.9 times, whatever the ratio could be. So that would mean that it would impact your returns, because if you do not have that 2 times exposure, if the index goes up by 1%, you don't get 2%. If it's only 1.8 times, which means that you will get 1.8% instead. Okay, so number one, exposure level is something that you need to understand that will impact the tracking. Number two, the daily rebalancing activity may result in us or the fund incurring higher transaction costs. So as you can see in the previous slides that I mentioned, almost every day, right, there is an activity to the fund, right? We have to buy more contracts or short more contracts, or sometimes, you know, you over the 2% already 2 times, you need to reduce your exposure. So there would be buying and selling activity of the futures contract, and that would result in the fund trading it, you know, in higher volume. But of course, the scenario that I gave you is also a little bit more extreme, right? Because I assume that the market move up and down 10% in a single day. In actual fact, you know, indices don't move, you know, in such great volatility on a daily basis. So in reality, most likely we do not actually end up rebalancing the portfolio so frequent. Okay, but just now was an extreme scenario to illustrate to you the activities that is done by the fund manager in order to manage this. Okay, now after talking about all this, right, we will also want to know what would be the risk of investing into L&I ETFs. So first thing first, long-term investment holding risk is something that we have always informed investors, because like I mentioned, due to the volatility and compounding effect of these indices, what essentially happens is that if you hold your ETF over a long term, you cannot say, hey, how come I hold it for 1 year? And if the, you know, underlying index makes, let's say, 10%, by right, I should get 20% return. How come I don't get 2 times the return? So because of the compounding effect, you may not get 2 times the return for the leverage ETF, and of course 1 time the opposite return of the inverse ETF. Okay, so that's a risk that you have to understand. Number two, of course, if you invest into the leverage ETF, then you are exposed to leverage risk. And likewise, if you invest into the inverse ETF, you are exposed to inverse performance risk. Other than that, portfolio turnover risk, because we rebalance the fund every day, we monitor the fund daily, you could end up incurring higher transaction costs as a result of that. Now, futures investment risk, we all know what happened to the oil futures contract last year, or was it the year before, when it went to the negative territory, right? So you know that when you invest into futures, the price can actually deviate from the actual underlying itself. So that is also a risk that investors should take note of. And the last is on trading hours difference risk, which only applies to products where the underlying index do not trade during our Malaysian time zone. For example, later on, I will share with you, we have a leverage and inverse ETF that tracks the NYSE FANG Plus index, where it has this risk, it carries this risk for the fact that FANG stocks are traded in the US hours when Bursa is closed, okay? Now, one of, just now the first risk that I highlighted to you was long-term investment holding risk. So then the question that, many investors would have that they will ask me would be, can we then as an investors invest into L&I ETFs for the long term? right? So it depends on your view of the market. Generally, I do not recommend investing into or holding the inverse ETF for a long-term period. Why? Simply because whenever we talk about index, okay, we always say that the index will go up gradually over the long term. We don't say that index will come down, go in a downtrend for a prolonged period. So that is the reason why inverse ETFs typically we do not recommend you to hold it for the long term unless you bump into the global financial crisis period where all the indices in the world generally is in a downtrend for a year or more. But if you look at nowadays the market cycles are getting shorter and shorter. If you look at last year's market, even though it's on a downtrend, it rebounded really quickly. Okay, so that's why holding inverse ETF for the longer term could be something that may not be recommended, but of course different investors could use it for different strategy, right? However, leverage in ETFs on the flip side, to me, I would think that you can potentially hold it for the longer term, provided that you are aware of the risk that you will not get 2 times the exact return of the underlying index. So if you are willing to take on that risk and understand the risk of this, then holding the leverage in ETF for the longer term may be all right. Okay, so I'm going to illustrate to you or give you example. So this is the performance of the S&P 500 futures contract versus the S&P 500 2 times leverage ETF, which is listed in the US market. So if I were to measure the performance of these two, right, the S&P 500 futures versus the 2x leverage ETF, you will notice that the S&P 500 futures make a gain of 121% over this period, okay? Whereas if you times by 2, right, you are supposed to get 242, right? But in this case, the 2 times leverage will not get you 242. Well, it's very simple. The reason is really because of the compounding effect. Because don't forget that when markets come down, you are compounding your losses by 2 times as well. Okay. Now, this is to illustrate to you, yes, you can potentially hold the 2 times leverage for a longer term, provided you must understand the risks of compounding, the risk of compounding effect, where you may not get 2 times the daily return of the underlying index. Okay. Now, let me then compare the NYSE FANG Plus futures versus the Trade Plus FANG Plus Performance Daily Leverage Tracker. So if you take a look at this product, which Afin Huang launched in 2019 November. And again, if you measure, if you take the FANG Plus futures, it's at 141%. If you times 2, it's supposed to be 280. But instead of achieving 280, we are at about 260%. So it is not going to be exactly 2 times. Okay. So if you are well aware of the risk, then you would have gotten a good returns as well. Now, one of the things that I want to also talk about today is the fact about liquidity. I don't know how many of you here actually thinks that ETFs are not liquid in Malaysia. How many of you here actually thinks that ETFs are not liquid? Can you please, tell me yes in the chat box? How many of you here actually think that ETFs are illiquid, not liquid at all? Can get in, cannot get out. That is usually the term that people will use. Ayo, everybody say yes. Spread is big. Yes, yes. Some say no. Only some say no. Okay. Now, I would define liquidity as the ability to get in and out. Okay. As long as there is somebody who is willing to buy back from me, then I will not consider this as illiquid. Okay. So number one, ETFs actually have market makers to provide liquidity. So let me give you an example here. As you can see, the HSCI 1XI, we manage 4 ETFs, okay? And you can see that the spread for HSCEI L&I ETFs are at 1 cent. Okay, the spread for FANG L&I ETFs are wider, but the price of these ETFs are also higher. Okay, so of course the spreads are bigger. I think one thing that we have to explain to investors is that number one, market makers need to make money as well because they are there to provide liquidity to investors. So if in an ideal scenario, we will think that, hey, you know, you're making a lot from the spread, but in actual fact, they aren't really making a lot simply because there is not enough participation in the market. The ideal scenario is if there is someone buying and selling at the same time, then yes, the market makers will make the spread. But because most of the time the market makers only have one side of the picture or the coin, right? So they are actually exposed to certain risks when they provide liquidity in the market. So liquidity in the market, participation or trading in the market versus the spread, right? I can only say that when there are more and more participation from investors, then the spread will tighten over time. Okay, so for a start, I think personally for myself, I don't, even if it's a 4 cent to 8 cent spread difference, if I measure it over the price of the FANG ETF, it is roughly about 1% spread. To me, I'm okay. I invested into the ETF and I'm happy because I'm getting 200 over, you know, percent. And so what is this 1-2% in spread? So I am personally not someone who will look at it. But if you ask me, I will have to agree honestly, to be very honest with you, the spreads are not the best. Okay, because the ETF market in Malaysia is not as vibrant as the ones in US. But if everybody were to just sit down and wait for spreads to tighten, the day will never come because there is no participation in the market. So it is a chicken trading volume and spreads. It is a chicken and egg thing. So we all have to, you know, jump into it and participate in order to tighten the spread, right? Okay, so I hope that that helps to address some of your concerns regarding liquidity. Okay, now, so what is available on Bursa Malaysia today? There are actually 6 leverage and inverse ETFs available. 1 leverage and 1 inverse each for 3 underlying indices. So first we have the NYSE FANG Plus. This is for investors who want exposure to the FANG Plus stocks. So what is in FANG Plus? Your Facebook, Amazon, Apple, Netflix, Google, your FANG. Plus is the kawan-kawan, Tesla, Nvidia, Baidu, Baba, Twitter. Okay, so these are the 10 stocks within this particular index. So if you like exposure, okay, into this technology team and technology play, then this could be the ETF that you're looking for. HSCEI is Hang Seng China Enterprise Index. This is an index that covers the top 50 mainland Chinese companies listed in the Hong Kong market. So if you think that, you know, you want to get some leverage or inverse exposure to the 50 largest Chinese companies listed in Hong Kong, then HSCI is the go-to index. The third pair launched by Kenanga is the KLCI Daily Leverage and Inverse ETF. And of course, this is our home base FBM KLCI. So if you think that, you know, there is potential in the KLCI, whether to long or to short, it could be something that you may want to consider. So what are some of the concerns that investors would have when trading local ETFs? Now, very frankly, okay, if I were to ask you this question, how many of you here actually think that US ETFs, because they are cheaper, their TER is lower, returns always better? Okay, say yes in the chat. How many of you actually think that because of the lower TER and the expense ratio, okay, TER is total expense ratio, because of the lower TER in the US ETFs, therefore returns must be always better? Okay. Okay, I think I will see a lot of yes lah, probably. Most of the time, yes. Depends on the currency exchange. Okay, looks like Azwan has attended my webinar before. You know the answer. Okay, I think most of you will probably say yes. Okay, now let me be very transparent with you. I'm definitely not here to say that we are better because we don't have the skill. Very frankly, our local ETF market do not have the scale of the US ETF, right? So if you take a look at examples, right, like the Trade Plus FANG Daily Leverage Tracker, and if I were to compare it with the Micro Sectors FANG Plus Index 2X Leverage ETF, well, very long name, FNGO in short, this is a similar product to our FANG 2 times. Okay, and the TER, as you can see, is also almost double. Their total expense ratio is at 0.95, and our ETF is at 1.61%. So first thing first, you all will probably say, "You're so high. How to invest? ETFs are supposed to be low TER, right?" Okay. The second ETF or the second pair that I want to compare is the Trade Plus Sharia Gold Tracker, which is a product that Affin Hwang manages, 0828EA, and the largest gold ETF in the world, GLD. Okay, who has US 58 billion in AUM, okay, and their TER is at 0.4% versus, again, our TER is almost double at 0.7%. Now, if we measure the performance, okay, so if you take a look at this slide, the performance of FNGO versus the 0830EA, the 2X leverage, you will see that, hey, you guys are loose hands down, man. People can get 340%, but we're only at 256%. Okay, let me explain why. So yes, we agree there is a performance drag. Why is that so? So if you can remember one of the slides earlier that I mentioned, right, there are two things that will impact the tracking of a leverage and inverse ETF. The first thing is the exposure to the futures contract. Is the fund manager able to get 2 times the exposure to the underlying index futures? So very frankly, at the start of the launch of from the launch of the fund, we are unable to get 2 times. So if you can see my daily exposure, it has been fluctuating from somewhere between 180% to even 100% at one point. Okay, which means that at the initial stage, our tracking really sucks lah, huh? Okay, and the reason for that is because the FANG contract is very large and our fund size is very small. So what happens is that we've been talking to the issuer of the FANG futures, and they have then worked to launch mini contracts. Okay, so they launched mini contracts in 28th of September 2020, and that helped us, okay, because the contract exposure then becomes smaller, right? The contract size becomes smaller. So the fund is then now able to obtain exposure closer to 200 and is more stable. Okay, as you can see that I've circled. Okay, so then let's track the performance of FNGO versus 0830 since August last year. Okay, as you can see during this period, the tracking has improved tremendously. Okay, so tracking has improved, one thing. The second thing that you have to take note is that currency, you only pay because you pay ringgit. Okay, and of course the performance here is measured in US dollar versus ringgit because our product is listed in ringgit and their product is listed in US dollar. So which is why currency effect could be something that you obtain from the local market. So it does not necessarily mean that when you invest into the foreign ETFs, they are better. Cheaper does not necessarily mean better. Local, even though it could be a bit more expensive, but it could be convenient, and you could potentially have certain savings, for example, like transaction cost savings. You know how much it is to trade foreign shares, right? What is the transaction cost that you have to end up paying? What is the brokerage charges, right? That's one. Secondly, what is the currency conversion spread that you have to pay, right? Those are hidden costs that you don't see it upfront, but it could be something that adds up. Okay. Now, the second example that I want to give is also the performance of the GLD versus the 0828EA, which both invest into physical gold and they are both gold ETFs. Now, again, as you can see, the performance of GLD versus 0828 has been quite closely, in line. And you can see that the 0828EA, since the day we launched up to today, it has slightly outperformed the GLD. Also, due to the currency effect. So sometimes, don't say that, the grass is always greener on the other side for sure. But if you don't give a chance to the local market, then also a bit susah for the local market or managers to eventually build up the AUM and the performance of the fund. Okay. Now, so how can you then qualify to trade ETF, L&I ETFs? So on top of having a CDS account, you have to fulfill one of these four, either or any of these four criteria, and declare to your broker before you can actually qualify to invest into the leverage and invest ETF. So which is why, Bursa Malaysia has very kindly produced short videos for you to understand the ETF without even, attending webinars like this. And then at the end of the day, utilize a performance simulator as well as do a little quiz and then get a cert so that you can qualify yourself to trade leverage and invest ETF. Okay, so what I'm going to do is I'm going to play another 3 more videos now and subsequently pull up the second poll that has a couple of questions. Okay.
In previous videos, we discussed the effects of compounding on investors' returns. This next series of videos examines how daily rebalancing leads to deviations from the underlying index for investors who hold leveraged and inverse ETFs longer than a day. Stay with us as we examine how a leveraged ETF rebalances its holdings daily under 3 different multi-day scenarios: when markets rise steadily, when they decline steadily, and when they're flat but volatile. Keep in mind that for the entirety of this video, we will be using leveraged ETFs for the example. But these same principles also apply when inverse ETFs are used. Let us look at what happens when the market rises steadily over the course of 4 days. For explanatory purposes, the index value is set at 100 and the movements are set at 5% per day. Leveraged 2 times ETFs seek to maintain a daily exposure of up to 2 times the underlying index. Let's say you're an active investor and you believe that the market will go up. You may decide to use a 2 times leveraged ETF to give you up to 200% daily leverage for your market exposure. If you read the market correctly and on day 1, the index rises to 105 points, a 5% gain, your investment will gain 10%, that is, 2 times the index's exposure. This 2-to-1 exposure ratio is reset or rebalanced every day, so that the leveraged ETF can achieve its daily goal. However, this daily rebalance can also increase or decrease your exposure to the index if you hold your position for periods greater than 1 day. The changes in exposure level can mean that your returns can sometimes be different than 2 times the cumulative performance of the index over a longer period. Rebalancing can be an effective mechanism to help pursue returns closer to the fund multiple, which in this scenario is 2 times. Let us assume this upward trend continues for day 2, 3, and 4. By the time you close out your position on day 4, the index has now risen to 121.6 points, a 21.6% gain. So while the index total gains for the 4 days is an impressive 21.6%, the 2 times leveraged ETF has returned more than 2 times. Daily rebalancing has increased your risk each day, and the subsequent upward index movements have caused positive compounding. Notice that this is more than double of 21.6%, which is the return of the index. This is due to a compounding effect as we hold the leveraged ETF for days. As a result, the leveraged ETF's accumulated gain is magnified and returns 46.4%. As a leveraged ETF investor, you need to recognize your increased exposure and risk, even if you believe the positive trend will continue. It is highly recommended that you constantly monitor your exposure level. In the next video, we will illustrate what happens when the market turns bearish instead. This video is for educational purposes only and not intended as investment advice. In the previous video, we saw how daily rebalancing decreases index exposure when the market declines steadily for periods longer than a day. Finally, let us examine what happens when the market is flat but volatile over the course of 4 days. Assuming on day 1 you decide to buy the 2 times leveraged ETF to give you up to 200% of market exposure. The index rises 5% to 105 points, so your investment value increases to 110 points, 2 times the index's exposure, or 10%. You then decide to hold your position into day 2. Unfortunately, on day 2, the index erases its gains and drops back to 100 points for a 4.76% decline. The value of leveraged ETFs sees a greater than 2 times drop from 110 to 99.5 points for a 9.52% decline. On day 3, the index swings back up to 105 points, gaining 5%, and the value of leveraged ETF sees a corresponding rise from 99.5 to 109.5 points. Again, the uptrend doesn't hold, and on day 4, the index declines 4.76% to settle back at 100 points. While the index ended flat, starting at 100 and ending at 100, the value of your 2 times leveraged ETF fell to 99 points and ended up losing 1% due to negative effects on compounding. Even though the index ended 4 volatile days with no change, you still ended up losing money on your investment. To sum it up, leveraged ETFs perform differently in different market scenarios. The key takeaways are: 1. The positive and negative effects of compounding are magnified in leveraged ETFs, where upward trending periods may enhance returns. Downward trending periods may reduce losses. And in volatile periods, compounding may reduce returns and increase losses. Similar deviations will appear for inverse ETF. Upward trending periods may reduce losses. Downward trending periods may enhance returns. And in volatile periods, compounding may reduce returns and increase losses. 2. Daily rebalancing leads to increased or decreased exposure levels for investors who hold leveraged ETFs longer than a day. For investors who are interested to trade leverage and inverse ETFs, do take the time to understand about the features and characteristics of the product before you start to invest. This video is for educational purposes only and not intended as investment advice. Not intended as investment best. This video is for educational purposes. In the previous video, we saw how when the market is on an uptrend, daily rebalancing could magnify and enhance returns for investors who hold their leveraged ETFs for more than a day. However, no investment is without risk. As with all investment products, there are risks involved when you invest in leveraged ETFs. If the market had taken a downward turn and remained bearish throughout the 4 days, you would have sustained losses on your investment. Let's see how that would happen. Again, let's assume you bought the 2 times leveraged ETF to give you up to 200% daily leverage for your market exposure. Unfortunately, your view of the market was wrong, and instead of going up, the index declines 5% from 100 to 95 points. The leveraged ETF returns 2 times of that loss and declines by 10%. In real life, you would exercise prudence and may consider cutting your losses. But for explanatory purposes, we will continue with this hypothetical scenario. So for the next 4 consecutive days, the index continues its 5% decline. The total decline is minus 18.5% for the 4 days. Even though your investment also declines significantly at minus 34.4%, it is not as much as 2 times the cumulative return of the index. Daily rebalancing has reduced the exposure each day. As part of the rebalancing process, the assets of the leveraged ETF are reduced to ensure that its market exposure level is consistently 2 times the exposure to the index. The result of this process is that you end up losing less than you would have if the leveraged ETF had not been rebalanced each day. Even though daily rebalancing mitigated your exposure, you must always be aware of your increased exposure and risk when you hold your leveraged ETFs for longer than a day. Constantly monitor your exposure level. In the next video, we will show you what will happen to your investment when the market is flat but volatile. This video is for educational purposes only and not intended as investment advice.
Okay, let me run through the simulator. Okay, so essentially Bursa Malaysia has been kind enough to, other than provide videos to investors, they have also given this performance simulator for leverage and inverse ETFs. And here there are 4 ETFs that is managed by Arvin Huang that's in this page. And basically this is to illustrate to you the how each and every market environment could potentially impact the returns of the ETF. So this is actually a very interactive thing where you can actually change the date. For example, if you want to hold this ETF from, let's say, 9 of April 2020 to the latest, then it is it's interactive enough to then let you know that if you were to buy during this period and hold it, the ETF would have recorded a loss of 15.57%, and that it will also tell you what would the 2 times cumulative HSCEI returns will look like. Okay, so this is for the 2 times leverage, and then likewise for inverse ETF, you could also change the period, okay, from which date to which date, and then it will give you a corresponding response. So other than assessing it through these pages, you can also go to the issuer's website, either Kenanga's website or tradeplus.com.my's website, to go through this performance simulator even after this webinar. Okay, but for the purpose of this webinar, perhaps you may want to simulate, right? What if you purchase the FANG leverage ETF at the market downturn, right, last year, maybe by somewhere in February you purchased this, and up to today, if you were to buy it since then, right, since 27 February 2020 all the way, hold it till now, you would have gotten 230%. So assuming, if you want to simulate the returns to say that, what if I bought it here at the market low on 18th of March, right? What would the returns be like if you would have held this ETF? And of course, for the FANG daily inverse tracker, also the same thing. You can either measure the performance since launch, or you could also measure it for the shorter term. Okay, so this is how the performance simulator actually looks like. Okay, and by going through this with me today, and if you answer the polls correctly, you would have qualified yourself to be a qualified investor to invest into L&I ETFs, and Bursa will actually issue you this certificate that I have here. Okay, so let me now pull up the poll or rather questions, the next 5 questions, okay, 6 questions actually for the next for this session. Okay, so let me pull up the questions. I've already pulled, you should be able to see the poll now. So there are in total 6 questions. Question number 5, let me just explain. Yeah, question number 5 actually is not really a question, because you're supposed to answer the answers for question 5 is to tell you 1 is compounding effect, 1, 2, 3, and you are supposed to answer question 6, okay, that says all of the above, none of the above, 1 and 2 only, or D, 1 and 3 only. However, in order to proceed, you need to simply click lah. So in other words, question 5, whatever you click doesn't matter. Okay, because that is not the answer. The answer to question 5 is actually in question 6. I hope I'm not confusing you guys. Okay, if you have any questions to ask, you can clarify. Oh, looking at the cert. Okay, yeah, I'm actually at the cert. Okay, yes, that's right, I'm at the cert. So what you need to do is I've pulled up the poll. All of you can see the poll, right? So you can start answering the questions. Sorry, I was told that you guys didn't see the simulator page. Let me check. Okay. Okay, my apologies. I didn't realize that I wasn't showing the simulator page. So I sendiri shock sendiri talk lah. Okay, let me just go through this again while some of you can answer the poll. Now, can you see the performance simulator now? Can you type yes if you can see the performance simulator? Okay, all right, good. Okay, my apologies. I've been shocked sendiri just now. Didn't realize. Okay, so this is actually the performance simulator by Bursa Malaysia. Essentially, it's a chart of the performance or return of the ETF that is the HSCI daily leverage tracker versus the 2 times cumulative HSCI return. Okay, and in this simulator, essentially you can just change the date, okay, to whatever date you want, and then you click on search. It will refresh itself, okay, and give you the latest return based on the date which you have selected. Okay, let's wait for a little while for it to load. Okay. Okay, and then if you take a look at the FANG, for example, if you want to simulate, what if you purchase this at the market low, let's say on the 19th of March to 8th of September, then what would be the returns of this particular ETF? Okay, give me a minute. Refresh this page. Okay, I think there is someone asking how to answer question 5 and 6 again. Okay, So for question 5, you cincai press any button, it doesn't matter. The answers is actually question 6 because they needed to split the 1, 2, 3 because it's very lengthy. So that's why they put it as answers, but it's actually, you know, not the real answers to the questions. So it just means that question 5, can cincai answer press any button, is not the real answer. Question 6 is the answer to question 5. Okay. Right, so this particular simulator, like I mentioned, if you were to say choose the date, right? And let's say if you want to invest during different period, then it should give you the corresponding return. Okay, I don't know why it's not updating. Okay, let's see. Okay, finally it's loading. Okay, so assuming like for example, the NYSE FANG Plus daily 2 times leverage, if you were to play around with the simulator, let's assume if you buy the market low and you hold it up to the market peak, you would have made a return of 422% for the NYSE FANG Plus daily leverage tracker. Of course, on the flip side, if you were to hold the inverse tracker for a long period, then your returns would be negative, okay, would be in the opposite of the index because the index has been on an uptrend since then, right? So let's assume we play around with this simulator for the FANG inverse. And if assuming you purchase it on the 19th of March 2020 and hold it up to today, you would have made a loss of 62%, okay? Right, so this is the performance simulator. This is how the performance simulator actually looks like. So of course, you know, you can always revisit this performance simulator. It is also available on tradeplus.com.my website, which is our Affin Huang ETF page, or you can go to Kenanga's website to you know, play around with the performance simulator of the Kenanga leverage and inverse ETF. Okay. All right, so let me check the poll to see how many of you have answered. Okay, so like I said just now, question 5, you can just simply press any answers, and then number 6 is the actual answers to question 5, okay? Okay, while you guys are still answering the question, we have actually come to the end of this webinar, or of which I will now take questions. So of course, before I end, just wanted to give a shout out to Bursa Academy. So you can actually go visit Bursa Academy website to unlock, you know, lots and lots of information, webinars, e-learning that can help you in your journey as an investor. Other than that, of course, you can also visit our website, tradeplus.com.my, to get a copy of prospectus, of fund fact sheets, of you know, portfolio holdings, whatever you want to see and learn about ETFs on our website. And you can also follow us on our social media. And we also have a dedicated WhatsApp number that you can WhatsApp to speak to our ETF specialist in case if you're too shy to ask questions here and if you want to learn more about ETFs. We also have a Telegram page, Trade Plus ETF, where we will also share bits and pieces of sometimes market update and also our ETF performances and NAV on a daily basis. Okay, now let's take some questions while some of you can continue answering the questions, okay, the poll. Now, how big is the spread? Let's take this first question. I think I've shown this in the previous slide. So HSCI, our spread is at 1 cent. The one for FANG is a little bit wider. It's sometimes up to 8 cent in terms of spread. Okay. Next question. All right. But through my first-hand experience, many brokers, including FSM, do not honor the certificate mentioned by Ms. Chong, even though they allow me to access even riskier structured warrants. What is the reason? Is Bursa aware? Okay. Yes, Bursa and us, we are fully aware of this issue, which is why we are working together to see how we can improve this. Whereas for FSM, I believe they have improved this process. They have recently allowed trading of L&I ETFs. So what you need to do is you need to go to their web page. I think my colleague just tried it this morning. You need to make a declaration in the FSM trading page before they open up the leverage and invest ETF for you to trade. Okay, I was told that it's not available on the web mobile app version, so the declaration has to be done at the web page. Okay, so go through. I would say that I am totally in agreement with you that we need to do something about it, which we are. Okay. And go to friendly parties like FSMOne who make things easy for investors. Okay. Now, second question, another question: who determined the daily rebalancing on ETF market maker? Does the price change or fluctuate? Okay. Daily rebalancing happens at the fund level by the fund manager. So Kenanga KLCI will be handled by Kenanga. Trade Plus ETF will be handled by Affin Hwang Asset Management. So the fund manager looks into the daily rebalancing of the ETF. What the market maker do is, based on what we tell them, because every day we rebalance and we will inform the market maker, hey, this is the latest position. And based on the latest position, market makers will calculate the actual price of the leverage and invest ETF and they will flash it out. Okay. And most of them are on algorithm base. Okay. So you will notice that for the FANG ETF, because the FANG stocks are sleeping during Bursa trading hours, that's why the price don't move as much. Okay. You probably see that the price is more or less stagnant throughout the day. Okay. For FANG. Now, next question, what is the management fee? Management fee for the 4 Trade Plus leverage and invest ETF is 1% per annum. Okay, 1% per annum. The reason for the higher management fee is because there is a daily rebalancing that activity, i.e. translates to more work for the fund manager. So for ETFs, generally, if it is very passive, like for example, we only do semi-annual rebalancing, like gold, not gold, gold we don't really rebalance, like China ETF, etc. We charge a lower management fee. Okay, but for this L&I ETFs, we charge higher because of the work that is involved. All right. Now, is it possible for the L&I ETF to drop to zero? A very, very good question. Now, I would say that because of the daily rebalancing, it is not possible or the chance is very, very low for the L&I ETF to drop to zero. Why? Because an index, right, hardly goes up by 50%. It doesn't go up by 50 or 100% in a day. Okay, so because we choose broad-based indices to track, right? If let's say if you think about, let's say the leverage ETF is 2 times, right? In order to knock it out totally to become zero, that index has to drop by 50% in a single day in order for it to lose everything, because it's 2 times leverage. Okay, and 50% drop in a single day for an index, it's almost impossible. Okay. But in the event, if it really happens, then it will be totally knockout KO already, kosong. Okay, if that happens. However, let's assume if it dropped 50% over a period of X days, then it will not go down to zero. It will go down to maybe close to zero because of that daily rebalancing activity. You can actually simulate this, you know, in your own Excel if you want to calculate, and it will not actually drop to zero. Okay. Next, can inverse ETF be leveraged 2 times 2? At this juncture, SC do not allow. Okay, so we have to comply to only 1 time inverse. I know that in the US, they are up to, I think, 3-4 times inverse leverage already, but not in Malaysia. Okay. Next question, for compounding effect, does it apply to only Bursa ETF or global ETF? Compounding effect for all the daily leverage and inverse ETF in the world, the concept is exactly the same. Okay, so in the US, whether you are looking at those triple Q, you know, the NASDAQ, L&I, or the S&P 500 L&I, or even, you know, in Hong Kong, the Hang Seng L&I, or Korea Kospi L&I, they work exactly the same way. The compounding effect is the same. Okay. Now, next question. How big is the premium of the quoted bid-ask compared to NAV? At this juncture, right, our market makers have been pricing it quite fair to the NAV. I think, okay, sometimes investors, right, you need to, how would I put this? Okay, NAV is calculated once a day at the end of the day. So you cannot measure the premium of the bid-ask versus that yesterday's closing NAV lah, because definitely it will be off, right? Because today when the market opened, the actual NAV will move. Now, I have a trick for you. In Bursa Marketplace website, there is this page that lists down the IOPV of the shares. Okay, so let me go to that page for you. So you can actually know how to get it. So if you go to Bursa Marketplace website, all right. Okay, later I'm going to talk a bit about the ETF cashback campaign as well that Bursa is running. And if I go to share market ETFs, okay, so this lists down all the ETF available on Bursa Malaysia, and take a look at this column called IOPV. So this IOPV will tell you what is the indicative NAV as at this point. Okay, then based on this, you will take a look at your bid and ask to see what is the premium or discount. Okay, so you have to monitor this on your own. But of course, sometimes even though this price can be slightly off than the IOPV, there could be another reason, which is IOPV is a bit lag. Okay, it's calculated every 15 minutes. So which means that if you are looking at it now, it may be calculated 10 minutes ago. So if the price is volatile and has moved a little further, then you will see that it might be trading at a premium. Okay. So we rely a lot on our market makers. We do think that we monitor our market makers, and their pricing so far has been quite in line with the actual intraday NAV. Okay, but I can only confirm for Trade Plus ETFs. Okay, I cannot represent other issuers and say that theirs is also accurate. I'm not sure. Okay, now next question. Okay, how should we proceed with the investment? So if you're interested to invest, I think first thing you need to get a certificate from Bursa, which later on I think Joanna will also elaborate how you can get the certificate. And then after that, you can go to FSMOne's website and then declare that you have qualified to trade, and then you can open up to trade already. Okay. How do I know whether I get certificate or not? Later on, I think Joanna will answer this question. Okay, is L&I ETF open-ended like unit trust or closed-ended? All the ETFs in Malaysia are open-ended, so it doesn't. The fund size, if you ask me, doesn't really matter that much. Of course, the TER would be impacted if the fund size is too small. But the market makers typically will come to the issuer or the fund manager to create units or redeem units like a unit trust. All right. L&I fees are the same as the standard ETF. Oh, no. L&I, okay. Fee standard, okay, if you're talking about the type of fees, yes, standard, like management fee, trustee fee, custodian fee, all the brokerage charges, etc., etc. It applies to L&I ETFs as well. The only difference is that L&I ETFs management fees are higher than the plain vanilla ETFs. Okay. Okay, next question. How does ETF similar or differ with option investment? I think the difference would be option investment or option similar to warrants, right? There is an expiry and you need to manage your expiry yourself. So the difference with the L&I ETF is L&I ETFs invest into futures contract, where the futures contract also has the expiry date. But the good thing is the fund manager is the one that manages manages the expiry. So which means that L&I ETF you can hold for as long as you want, but options will expire. Okay. Next question, how do I control the loss when index direction goes against my leverage ETF? Can I place a stop loss price to exit trade? Technically speaking, you can. But it depends on your broker lah, because I think if you want to put stop loss prices, the broker system must be able to allow it. Okay. What are the times where the market maker would determine the daily pricing? Daily pricing, market makers actually calculate it on the fly, so it changes as corresponding to the market movement. Okay. I miss out on the requirements to trade L&I. Okay, maybe I can just flash out this slide again. Okay, you can read it on your own. Okay. For normal ETF, can we look at IOPV to gauge the position of the ETF? Do we have something similar for L&I? IOPV for L&I is also calculated, so you can use the same column. Okay. All right. How many days can L&I ETF be traded? Because ETFs are listed on the stock exchange, you can even do intraday trading if you want to. If the market is volatile enough for you to profit, you can actually do intraday trading. There's no minimum requirement. You can even do T+1. Today you buy, tomorrow you sell, also can. All right, doesn't matter. It's like shares. How long should one hold the leverage ETF? What is the optimal time? And what's your recommended exit plan? Just now I show you the slide of the S&P 500 2x leverage and also the Trade Plus FANG 2x leverage, right? As you can see, I don't even see if you should exit at this juncture. So it depends on yourself, really. Are you one who wants to look into, say, doing technical analysis to determine to time your entry and exit? If you are, and if you're looking at short term, then you should time your entry and exit accordingly. But let's say if you're a long-term investor, okay, if let's say I'm a long-term investor, I'm a little bit more, I have a higher risk appetite, okay, and I believe in the S&P 500 or I believe in the FANG stocks. So instead of buying into FANG ETF or S&P 500 ETF, for as long as, like I mentioned, for as long as you understand the risk that over a long-term period, you won't be able to get 2x the return, I would have gotten more than 1-time return, right? If you were to hold the S&P 500 2x leverage or the FANG 2x leverage, I would have gotten more than the 1-time return of the index. I'm happy, okay? So I could hold it for a long term, right? So if you ask me, there is no, a fixed exit plan. It really is up to you whether you believe or in that particular index or stocks of this or the component stocks within that index, and of course your preference long term or short term. Okay. Okay. Average. What is the average cost of investment? Are you talking about the total expense ratio? Because if you are talking about the total expense ratio, then you can get it from the reports, the annual or semi-annual reports. Okay. Like I showed you just now for FANG, it is at about 1.6%. Okay, of course, this is the cost of the total expense ratio of the fund, and you have to take into account your brokerage cost. Your brokerage cost could, is up depending on what the brokers charge you. And stamp duty for ETFs trading in Malaysia is totally waived up to 2025. So you only need to pay clearing fees and brokerage fees. All right. Okay. Last question that I will take today is, will L&I ETF declare dividend or bonus issue? Typically, it doesn't declare dividend because it invests into futures contract. So when let's say Facebook stocks distribute dividend or declare dividend, the futures contract don't get the dividend. So there won't be any dividend. Okay. But like I said, you are getting that 2 times exposure already. So this dividend, you can forget about the dividend in this case. Okay. Now, so I think that's all the questions that I have for today, and I've answered everything. So some of you are still answering the poll, so you can continue and go ahead. And I'll pass this time back to Joanna.
Thank you, Ms. Chong, for the insightful presentation. For those who have participated in the poll questions, results will be ready by approximately 2 weeks via email. Certificate will be available for download via Bursa Academy website, so please just check your inbox for further instructions. Alternatively, you can head on to our website and click on any leverage and invest ETF. And then when you click on buy, the system will pop up a notification for you to declare that you are qualified to invest. Once you declare, you can continue to invest. As for those who have the cert, you can email us the cert, and then we will change it in your account. Then you can start to invest in the L&I as well. If you have further questions, feel free to send us an email at clienthelp.my@fundsupermart.com. Link is in the chat box. A replay of tonight's session will be available right after this. Head over to our YouTube page at FSMOne Malaysia to catch this replay. We are having another webinar session tomorrow, which is Saturday, 11 September, where we'll be talking about bond investment strategy. If you haven't registered for the event, please head on to our website now at www.fsmone.com.my and register. Once again, thank you very much, Ms. Chong, for joining us today, and thank you everyone for attending tonight's session. Good night and have a good weekend.
Thank you. Bye.
Bye-bye. Thank you.